indicating to a 75% rate cut in as early as June.
Wow.
And of course, I don't know whether the handover from there is going to give us that sort of home run, but nevertheless, we will start off good.
Now, most Asia, most EMs, softer USD, softening bond yields. There is no reason why emerging markets in Asia should not latch on to this narrative. I'll be really surprised if it doesn't happen.
You know, I saw an interesting quote. This is a market that wants to look at the glass half full.
But it is a glass half full.
Think of it this way, your year-on-year inflation is still 3.4%.
Yeah, but you discount the future. Look at it, rents are going to go down.
So this is glass half full. You can look at data either way. You're choosing to look at it as not even half full, more than half full, and that's what the global sort of setup is. Let me quickly go through that before we get Seth Freeman on to give us a sense of how sustainable this global run will be. Suffice to say, fantastic trade overnight on Wall Street. Record close for all the three major indices. S&P 500 closes above the 5,000 point for the first time. Dow up 349 points, Nasdaq up 1.5%. Now, why is all of this happening? We told you that the April CPI data is going to come in. That's a key indicator that the street was watching out for, and it came in line. So 0.3% month on month was the rise. Estimate was 0.4%, so slightly better. On a year-on-year basis, it's also in line as far as what estimates are concerned, so at about 3.4%. It's a little ahead of the Fed target, like I said, but in line with estimates. And for a market that wants to see the glass as half full and perhaps even overflowing in the future, it's good enough. So you saw the 10-year cooling off to 4.32%. So it's even below the 4.4% mark after that data has come in. Crude also slid a bit and then recovered. So crude is a slightly different story going on. Your outlook by the IEA for crude demand has dropped. Inventory levels are still a little low in the US. So you had Brent to about where it sort of has been for the last few days, $83 a barrel. I'll just quickly pull up Asia and see what Asia is looking like. It had a pretty strong opening, but we'll see what the current is. Yes, all green over there. Hopefully we continue with that trend. What is our implied open telling us? Are we going to see a good start of the day? And yes, better than what we've seen most of this week. So maybe 90 points up. Quickly take you through the fund flows before we get our conversation on with Seth Freeman. And look at what the fund flows have been in trade yesterday. FIs are continuing to sell, 2,833 crores. DIs continue to buy. So nothing really changes there massively. But what I found interesting, guys, as far as, the Fed outlook is concerned, and Samina, you were mentioning June. So the wild swings in expectations. The beginning of this week was first cut in September. Now maybe two cuts before 2024.
And the irony is, in the same breath, we talk about the Goldilocks scenario, stagflation. I mean, those are two opposite ends of the spectrum, right? So if you keep that in mind, all of this is money chasing risk assets. And then, of course, in hindsight, everything is 2020, right? So that's pretty much what we have in terms of global cues. The S&P 500, though, is up 11% year to date. Indian markets are far from that. Of course, we've got this big event lined up in the next couple of weeks. My only thought is that if we do get an outcome at the elections, which is better than expected, there could be a big catch-up rally that D Street will see. All that FI flow leaving us may just find its way back very swiftly.
It's waiting for June 4th.
Yeah, and they rather buy the premium, and that's so. Even though we may get a 90-point gap up this morning, there is that event risk, right? So of course the gains may not be as euphoric as the rest of Asia this morning. But Seth Freeman, Managing Director of B. Riley Advisory Services, joins in now to talk to us about what he's making of all those data points coming in from the US. Morning, Seth. Great having you on the show. What have you made of the reading? Everything pointing towards a very dovish sort of stance, better than expect or lower than expected inflation, retail sales not picking up too much, a Fed rate cut around the corner. Is that what is cheering risk assets, or do you think it's just the flow of money and then we are finding justifications of what the buying is coming in for?
Well, there was a slight reduction in inflation, which is positive, but we always have to remember that 1 month is not a trend. And so even though this is exciting news, it doesn't mean that the Fed is going to act quickly.
Set the point about, yes, one swallow does not a summer make, but almost everybody talking about how rents are going to go down, and that should aid the inflation slow down. Will the markets latch on to the narrative even if the Fed does not act on it? And will, therefore, Asian markets rally further?
Well, you raise a good point. You know, there's competition for money flows. And so if U.S. rates go down, it could make the returns in India and other emerging markets, you know, more attractive. But there's still concern about just basic overall risk. And I think even though there's a lot of cash, a perception that, except for India, frankly, there's a lot of risks in other countries.
The India story, according to you, Seth. So what we were talking about just a couple of minutes before we got you on is whether 4th June becomes that D-Day when FII flows then start coming back to India. You've seen a one-way street for the last several days. And, you know, does it all sort of hinge on these election results?
I don't think so. I think there's a couple dynamics going on here. You know, the Indian market had quite a ride, especially in the small and mid-cap stocks. So you're probably seeing some money just being taken off the table. The other thing, frankly, is we see money flows slow down in the summertime. So plus we have, you know, it's in May. People are looking at their performance for the first half of the year. So I think these are the things that are also on investors' minds.
That's interesting. Summer break, maybe, funding those great holidays. Thank you so much, Seth, for joining us this morning. Seth Freeman there, setting the stage. So yes, the inflation numbers in the US look good. Just to add that jobless data is going to come in, and all of those data pieces have to come together to fit the bigger picture till, you know, Powell ji actually comes and says,
Powell ji.
हाँ, हमारे हिसाब से Powell ji आकर बोलते हैं कि, you know, now काटो.
So, I mean, this is going to be peer pressure, right? काटना नहीं होगा भी तो इतना आवाज हो चुका है दुनिया में that they will have to just go out and cut rates.
You know, if he had to give in to peer pressure, it would be long gone. There's an election there, and he doesn't seem to care. So,
and the markets don't seem to care what they get.
But you know, so just before we get to trade setup, I was reading the Nomura note this morning. Their US team has noted, and this is fairly pertinent, that lead indicators suggest that there is moderation in rent, which is likely to continue into the second half of the year. And the recent moderation in the labor data points to further slowdown in super core services. If all of this is in place, even if Jerome Powell doesn't cut, you can make an assumption that the markets will want to latch on to the belief that there is a higher probability
of a rate cut.
And somehow something that the markets may rejoice. Now, at least for today, it does seem to be the case, guys, that the global rally.
It's very unlikely that the global rally as it is will fuel us to that extent, right? Because we will find resistance at higher levels, largely because of the June 4th event. And maybe that may not be too bad. Once the event is behind us, we will probably, hopefully, outperform the rest of the world if the outcome is better than expected.
Yeah, it's a good binary outcome.
It's the only way I want to look at it now. Yeah. Justifying if we don't catch up with the rest of the world.
I think the nervousness has eased last couple of days, I would say, just on the basis
political
of data.
nervousness.
But we saw what happened yesterday. There was resistance.
Yes, but think of it this way, 9 straight days of significant FII outflows. If that picture, even if it doesn't turn, but recedes, you know, and then there's DI buying or whatever, then let's see. I mean, somehow today at least
you feel okay about the markets this morning.
I mean, remember we were debating this on Monday morning that at the end of Friday we'll be at much higher levels than what Monday is showing.
Let's see.
It does look like for now we are set for that, and the broader markets certainly we are set for that, because yesterday the Nifty may have been flat, but the broader markets had a decent move.
And the Nifty will continue to remain flat till significant FI flows start coming in. large cap is where ETFs play the big game,
Yeah.
right? Passive funds are focused on your frontline names. Those are obvious. The connection is obvious because if FIs are selling, large caps are underperforming. Broader markets is where the DIs like to participate, and sectors have been doing exceptionally well. So defense, fertilizer, railway, these are local and domestic themes which retail investors or investors in India usually like, and that's obvious. So that's a very fair assumption to make. Large cap still waiting for its day in the sun.
Most certainly. And just to add levels to that, so one, I mean, just the fact that the global rally may take the Asian markets higher. The Nifty Bank yesterday held above the 50-day moving average. For technical experts, that's supposedly a big thing, and most people are saying that a breach above 48,000 could actually result in fresh longs as well. And just a couple of points. I mean, this holds true more so for the Asian markets, but the fact that the rally in the US markets yesterday is on account of what's happened to yields and the inflation data could mean that tech and REIT stocks, and India now has 3 REITs out there, but tech in particular could well see an uptick in trade today. And I dare say it's an interesting day of results today as well. There is only one index name in M&M, but Vodafone and the commentary from Vodafone could be interesting. InfoEdge, what PB Fintech and Zomato have done could be very interesting to see what InfoEdge numbers look like. Biocon, there's so much of news flow around this one about whether there is some bit of a corporate activity or no. And then Motherson, Sansera. So it's a clutch of very interesting names that come out of the results today.
So, well, of course, if you want to talk about results, but, you know, just going back to the market momentum, metals, they were up, 5%, 4.5% yesterday. And if we are sitting on an expectation of a rate cut on back of US data, higher commodity prices, a weaker dollar, higher commodity prices, your stocks like Vedanta, Hindalco, NMDC, GAIL may continue to see some more buying in today's day of trade.
The big theme yesterday, though, and I wonder if that will continue, is all your government-run stocks.
PSCs,
Public sector companies were just on fire. You know, the fire emoji on. So I don't know if that continues. In fact, so many results today and so many big, numbers to watch out for, stocks to watch out for.
Yeah, we'll take you through all those stocks. And yeah, just to put that in perspective, a bunch of mutual funds aggressively have gone out and loaded up on metal stocks. And that's why you're seeing the kind of movement that some of these metal names have been seeing in the last couple of days of trade. So be it an ICICI Pru mutual fund, HDFC, Nippon, these are some of the funds that have gone and picked up metal names like Vedanta, etc. Well, in terms of counters to watch, I'll start with a metal name this morning. Well, Jindal Stainless reported numbers. I don't know how the street's going to look at it. No brokerages has commented on it yet. The stock was whacked in trade yesterday. It was down 4%. Revenues were down 3%. EBITDA continued to decline this time around as well. So it's been not much of a relief from what we saw last quarter for them, down 9.5%. Margins have also declined. Maybe not too much of a cut on margins, but still I think 100 bips, 150 bips lower on margins is what we have. In line with what Bloomberg estimates were, but those numbers are not in line, not going to be appreciated by the street. Profits have taken a big hit of over 30%, coming in at 500 crores versus 716 crores. Another one that stood out for me was Berger Paints and Mankind Pharma. In Mankind Pharma, profits have beat estimates. There has been significant outperformance in key therapies like cardio, antibiotic, and anti-infective. Exports business has seen a substantial growth, so 230% jump YOY in the fourth quarter and 29% Q on Q in terms of export business. The management has said was a one-off opportunity in the US that helped the numbers, but nevertheless looks good on the face of it. Revenue grew 18%, but EBITDA and PAT have also up 25% and 19%, and that's what you want to keep in mind. They've talked about raising funds to the tune of 7,500 crores. It would either be through a QIP or other modes. So Mankind Pharma is what you want to watch out for. Good numbers from the way we look at it. In terms of Berger Paints, revenues were at 3% higher. EBITDA was down 4.8%. Margins have declined quite sharply to come in at 13.9 versus 15.1. Net profit was up 20%, and that's largely because of other income. So other income in the same quarter last year was 15 crores. In this quarter, it's 48 crores. And you can see that, right? Your revenue's up very little, but your net profit number's seen a bigger jump of nearly 20%. So, and your margins have declined. So despite that, profitability is up on back of other income. If that was left out, the core business itself is actually not looking good for Berger Paints. We saw it with Asian, we're seeing it with Berger as well this morning. Beyond the front line, I think there is some weakness in the paint sector.
I wonder if new entrants and competition is, hitting a Berger.
Yeah,
because if you have a number 2 player coming in, they're probably going to gobble up market share from the
existing players.
The weaker ones rather than the number 1 first, I suppose. So you've seen Asian Paints also suffer a bit. So, the set of numbers I have, I think one consistent theme is that there are stocks that have run up, that there's been a lot of positive news flow through the quarter, and now is the time to see if the numbers live up. So let me start with Dixon. On the face of it, numbers are good, but there is a miss in terms of what the street was expecting. So revenue is up 52% at 4,658, slightly below Bloomberg estimates. EBITDA up 19.2%, little over Bloomberg estimates. EBITDA margins have, come down a bit, 5.2% versus 6.7%. Net profit up 20.7%, but again, a little below estimates. So top line and profits have missed estimates to some extent. EBITDA margins have also dropped. The big jump in revenues has actually come from the mobile and EMS segment. That's up a solid 119%. Lighting and consumer electronics segment has seen a dip in revenue. But remember, this is a company which has so much going for it. All your PLI schemes, etc., and they're right at the forefront to make the most of it. So the outlook from the con call takeaways at least looks fairly positive. The partnership with Samsung, Tizen OS, all of that rolls out in Q1 FY25. So the stock may take that into consideration. But looking at the way it's run up, perhaps you might see a bit of pressure today. Nuvama has retained a hold on Dixon. The target price is at 7,857. So they are looking at a slight potential downside. The mobile-led high growth narrative, of course, continues. And then you have that policy push that you want to make in India, etc. So Dixon will benefit from that. But I don't know if the numbers are living up to what the expectations are, at least for Q4.
Yeah, so. And maybe the conscious call that they have now taken that because we want top line growth, let's go into mobiles in a big way. They've guided to a steep ramp up in mobile revenue in FY25.
Yeah.
And if that continues, then EBITDA margins can't be 5%. They'll probably be 3%. So I think the conversation with the management today would be very interesting because that's what we should try and find out from them. That is 3% the new normal, or do you foresee some ramp up there? Because mobiles will not give you margins for sure. They'll give you revenue, but not margins.
I don't know, I'm just thinking aloud, but once you capture the market share in terms of top line and mobiles, can you then sort of push pricing and then improve profitability?
Maybe not with brands like Samsung, etc.
Yeah, commoditized.
Not with brands where anyway your margins are wafer thin, and you're never going to be, for such a hugely commoditized product, in a position to really capture that much of the market. So Dixon might see a bit of a soft start. And yes, we will be speaking to the management later, so watch out for that. Titagarh Railways is the other one. Revenues below expectations. So when I talk about the category of companies that, the street has rewarded in anticipation of their profitability, and then you have to sort of show up, with the marks on result day. So Titagarh perhaps has not. Revenues below expectation, PAT in line at about 79 crores, that's 63% up. Margins at 11.4% versus 9.8%. So revenue growth is led by the company's larger segment, that is freight rail systems, which is what pushed about a 26% growth. Passenger rail systems segment has declined quite sharply, 78.6%. So other expenses is what has bumped up that EBITDA margin growth. And net profit growth was also led by higher other income. So you might see, not a great start for Titagarh either. Again, a company that we'll be speaking to, so we look forward to that conversation. NLC was the third, and this is a disappointing set of numbers. Revenue down 31%, EBITDA down 65%. Margins at 17% versus 33.5%, so very sharp drop there. Profits also down 86.4%. So the management has a lot of positive things to say. They're going to, have a green energy division, etc. All of that is great. Government-owned company. But on the face of it, for a stock which has been quite popular with retail investors, they don't seem to have delivered in terms of their numbers for the quarter. So those three in, the first cut of stocks that I think you should watch out for today.
Yeah, NLC for the last 5 quarters has had EBITDA margins northwards of 24%, and they've come in at 9% with the numbers because, look at employee expenses shooting up the way they have, and the other income for them down 30% from northwards of 700 crores to 494 crores. No surprise that the PAT number is looking the way it has and wobbled. So clearly a stock that could be amongst the top losers today. I don't have too many stocks really, just a couple up on the results at least. Pitti Engineering, much like Berger, but in higher OI, lower tax outgo, prop the PAT growth. But the revenue numbers, revenue numbers were okay, 32% actually, at 328 crores versus 248 crores. So the revenue number looked okay, but the margins corrected a bit, 14.8 versus 16.4, so not that great. PAT was up above, of course, 62%, like we said, because of higher other income, lower tax outgo, both of which propped the PAT growth. So decent PAT performance, decent revenue performance. Margins took a bit of a hit. Not a very liquid stock, but keep this in mind. From amongst newsmakers, PSP projects could be in focus. Settled the dispute with Surat Diamond Bourse, and the Surat Diamond Bourse has agreed to pay 170 crore rupees in tranches. So do watch out for that one as well. And last but not the least, just wanted to bring out, amongst other things, and standard disclaimer, of course, that talking about an Adani Group stock, and the Adani Group owns NDTV, and you're watching NDTV Profit, but the Morgan Stanley note on Adani Ports is very interesting, wherein they've spoken about how, amongst everything else, they are pretty enthused by how the company has done much better than what their own estimates were with regards to what they've executed and the guidance. So on that front, it looks pretty strong, really. Just the note, they say the 5-year plan is ahead of our estimates. The FY29 expected targeted growth across both the ports and logistics business is ahead. The guidance that Adani Ports seems to have given is that the cargo volume is targeted to reach 1,000 metric tons by FY29. 2 export revenue and EBITDA growth. ROC of all major ports targeted to be above 20%, and 7x logistics revenue and EBITDA growth. So all of this makes Morgan Stanley say that the 5-year plan is ahead. They remain overweight. Their target price is 1517, which is a modest 14% upside. But just the fact that the targets given by the company are so strong, let's see if that stock continues to be in focus, because remember, both the Adani twins on the index at least have been up and running for the last 2 or 3 sessions. So the momentum is certainly in favor.
The Adani Energies of the world have done exceptionally well.
That too.
So up 3%, 3% yesterday. Enterprise, of course, was up 6% day before yesterday and continued to hold on to these gains. Very quickly, just one more, because it's interesting because Somani Ceramics reported numbers. Numbers were okay, but Citi has a pretty aggressive buy call, which they've maintained on the counter. So I'll highlight those numbers and take you through what's expected. Revenues were up 9%. EBITDA was up substantially, up 31%. Margins have improved to nearly 11% versus 9%. And net profits were up 39% for Somani to come in at 34 crores versus 24. But what stood out for me is Citi maintains a buy with a target price of 914 on Somani Ceramics with a 46% upside. So that is what stood out. IEX reported numbers. The stock really has been a dull one recently, so not really worth a mention. But yeah, I guess the monsoon is the big story this morning.
Monsoon's the big story, and it'll be for Apollo Tyres as well. Very quickly, before we get to the monsoon story, 2 notes out on Apollo Tyres. The results weren't too exciting. Stock took a bit of a tumble yesterday, and you just pull up yesterday's rate. Nomura has maintained a neutral with a target price of 512 on Apollo Tyres. He's an upside there. Focus on favorable mix and price hikes to support margins. Market share remains stable in replacement. And they say a price hike in May of 3% will need another 2% hike. Of course, commodity costs are up. Citi's also maintained a buy with an upside of 21%. Their target price is 570 actually. And they say management is cautiously optimistic. India demand growth expected to revive post-election. So elections is one big factor for the markets and a very large number of companies. The other big factor, frankly, is the monsoons. And the IMD report yesterday saying that monsoons will commence from 31st of May, of course, plus minus 7 days, as is the norm. Now, GP Sharma from SkyMet is joining us this morning just to give us a sense of what is the kind of monsoon we are looking at this year. Remember, very important indicator that the market looks at, important for India as an economy, agrarian dependent, etc. So, Mr. Sharma, good morning. Thank you for speaking with us here at NDTV Profit. Are we looking at an on-time normal monsoon this year?
Good morning, Tamannna. See, onset of monsoon and the health of monsoon, total season, that is, these are two different aspects, okay? So good news on the monsoon front that it's arriving on time, 31st of May. The SkyMet estimate also was around 1st of June or so. That means within about 1 day or so. So that's okay, and it's a good news, particularly so because last year was a slight dampener when the monsoon arrived on 8th of June, and also it was not very active to start with. But then this time it's absolutely timely, okay? And earlier also there was good news when it's expected to arrive on the Bay Islands. That's around 19th of May. Conditions are becoming favorable, and it takes about 10 days from there on to reach the mainland Canada. Okay, so it is following the timelines, I will say, this time. And 31st May or 1st of June, that should be the date. Margin error always remain about 3 to 4 days of the model. So within that, the monsoon should arrive over Kerala coast. Okay, the pre-monsoon showers I see hefty over Kerala before the arrival of the monsoon. Actually, it should start anytime around this week itself, on the weekend, and even just before the arrival, there is going to be a hefty monsoon, pre-monsoon activity rather, over Kerala. How it pans out as a season, that is to be seen later. Though the forecast is, we have given that it's going to be a normal monsoon and slightly above as by the IMD, but then hopefully it should be a decent monsoon, and the last year below normal monsoon should become a past, and then we look forward to a decent start. Yes,
that's excellent. That's excellent if you have a normal monsoon, because the below average monsoon last year, led to a lot of rural distress, etc. But Mr. Sharma, actually the big question about monsoon over the last few years in India is not so much what the aggregate figure is at the end of the season. It's about how consistently you see monsoon, because you have patches of very heavy rains which ends up destroying crops, and then long spells of dryness. Anything that you can forecast in that direction?
Absolutely right. The spatial distribution, the timely arrival of the rains over different parts. Particularly, we have the core monsoon zone, which largely depend upon the monsoon rainfall. All these are very important aspects. But then, you see, that SkyMet also, we have given our forecast that the monsoon generally should behave. It should be okay for the southern parts, for the central parts, for northwestern parts also. Eastern parts will be a little worry as far as possibly Bihar, Bengal, and parts of Jharkhand, Odisha, that is concerned. But Northeast India, in any case, they have a surplus rain. So even if there is a shortfall of about 10% or so, it doesn't matter much. So overall distribution also should be okay, but then monsoon always it plays a truant, it is true to its behavior. It leaves some cycles in between, wherein there are some floods and there are some heavy rains, extremely heavy rains also. Frequent heavy spells are there. So that will definitely be a part of is a feature of this particular season also. Where are these going to be? That becomes definitely that will be assessed a little later, but mostly middle of July onward, we can expect the central parts of the country, northern parts of the country, including traveling up to Maharashtra and Gujarat. These are the parts which are to be watched for some excess rainfall, heavy rainfall, extreme rainfall events activity over these parts.
Okay, no, so Mr. Sharma, just one point about the heat wave, because a couple of months ago we were talking about heat wave laden summers. That story is over after the 31st of May?
No, Tamanna, you see, the North India, possibly the first wave of heat, the heat wave possibly severe in some pockets, that's going to commence anytime soon. This weekend going to be very hot, even for Delhi. For the first time, possibly we have the temperatures reaching 44, 45 degree. And then parts of West Rajasthan, where in the border posts, Jaisalmer, Barmer, even Falodi, Bikaner, Jodhpur, these parts you can expect the temperature to climb even excess of 47, 48 degrees also. Entire North India, the first spell of extreme heat is likely. Even after the monsoon sets in, yes, you can say it's the southern parts of the country, South Peninsula, or even partly the central parts, they can possibly take a sigh of relief that the extreme heat is over from those parts. But then North India, possibly we have to wait because the monsoon arrives only end of June or so. So the extreme heat events, they will be there. Punjab, Haryana, Delhi, Rajasthan, parts of Madhya Pradesh, even entire Uttar Pradesh. But then relief definitely for the southern, entire South India. Once the monsoon comes, it becomes better and better. Yes.
Yeah, absolutely. Thank you so much, Mr. Sharma. Always a pleasure to speak with you. So
Thank you.
That's really the good news, isn't it? I mean, if you were looking for more positive cues today ahead of markets, US markets, and a good monsoon on time is always, a positive cue.
Yeah, boost rural consumption. That's the big story anyway that the markets want to focus on to this year. So I think policy continuity, a good monsoon, capex could keep the India story intact for the next couple of months at least. Implied Nifty is indicating to a fairly good start this morning. A 90-point gap up is what we should be expecting. 22,300 is going to be an interesting level to see trade at. Whether or not we sustain at those levels or see profit taking is anybody's guess. But we'll tell you what the F&O data is pointing to just after this break, so stay tuned.
Welcome back to India Market Open. We're taking stock of the futures and options space and seeing what's going on out there. Yesterday it was a flat day of trade with not too much traction as far as your absolute change in the underlying goes. But we did see a lot of unwinding as far as the Nifty futures are concerned. In fact, a decline of nearly 4% in open interest there. The Bank Nifty, the picture was slightly different. And when it comes to that, the underlying, in fact, came off by around 0.4%. And in open interest, increasing by 4.5%, indicating some amount of short build-up as far as the Bank Nifty goes. But remember that today is the weekly options expiry for the Nifty, which means that the Nifty will be in focus, perhaps an expectation of more choppiness coming in. In terms of activity, when it comes to the Nifty options, it was all over the place. But as far as the open interest distribution is concerned, at the moment, we have significant amount of open interest built up around the 22,500 call. On the lower end, the most standing at around the 22,000 put. This may or may not be a rough range, but this is where a lot of traders are placing their bets as far as today's weekly option expiry is concerned. But to remember that the India Volatility Index has moved above the mark of 20, remain there, and this also means that option premiums at the moment are relatively more expanded. So that perhaps is what a lot of these option writers are trying to take advantage of, that higher option premiums. But let's move on and talk about the 6th June expiry, because that also now comes into focus. And we'll be talking about the 6th June expiry every day until, of course, the 6th of June, certainly until the 4th of June. That's where you have the outcome of the general elections. So what we are observing here is continued, traction and a significant amount of writing around the 22,000 call as well as put. This is one of the most active strikes as far as the 6th June expiry goes. And the other one, of course, is the 22,500 call and put as well. Now, these two strikes have stood out over the course of the last 3 to 4 days. And I reckon that we will see a lot more action. And I reckon that we will have a lot more experts also suggest as to what we can do with this specific weekly options expiry as we move into trade over the course of the next few weeks. But let's move on with that and talk about stocks which are in focus as well. Shorts for Canara Bank and Granules along with Colgate, Metropolis and BPCL on the other hand looking at longs coming through. And among stocks which saw unwinding, well, we're about a short covering for, I wouldn't call it short covering for Siemens because it's continued to move in and continue to make a life high. And Birlasoft, of course, looking at short covering and a long unwinding for Shree Cement, Aarti Industries and JK Cement. But with the kind of data that we have, the question really is that what can this data tell us? What kind of an advantage can we potentially expect to take based on what our observations are? Well, let's get in an expert opinion. We have Rahul Ghosh of Hedge.in who's joining us this morning. Rahul, good morning. Thanks for joining in. Let's start off once again, as usual, with your assessment of the benchmarks. And perhaps if you could also suggest an option structure that we can employ going ahead.
Good morning and thank you for having me. So with respect to Nifty, you're noticing there's about a 90-point gap up or thereabouts today. Very, very simple view. If this gap up remains, then the trend has changed to the upside. Till the market remains above 22,000, all dips should be bought and you can expect the old high to come about. If the gap up does not sustain, then I would suggest wait and watch to see if markets are going below 22,000 or not. If markets go below 22,000, do not short. Even though the put writers are highest over there, I've always mentioned that the premium has to be taken into account. The short level for short is below 21,800. That is when Nifty breaks 21,800 is when you go and short. With respect to long, very simple. If you see for the first 3-4 hours, this level is sustaining, the gap up is sustaining, you can go ahead and go long. Keeping that in mind is exactly how we've planned a long strategy. This is a butterfly. It's a modified call butterfly. It has 4 legs and is a bullish strategy. Shall I go ahead and design it for the viewers?
Yes, please go ahead and explain this one.
All right. So what we're doing is we're using the May expiry and we're buying the 22,500 call of May expiry, thereby having a bullish bias. Number 2, we are selling the 22,650 call again of May expiry. Now, this is a simple bull call spread. The trouble with a simple bull call spread is if markets turn down, then your bull call spread loses significant amount of money. To combat that significant amount of loss, we add two more legs. Now, what are the two more legs we are adding? Number one, we are selling the 23,000 call of May end expiry. This helps curtail any movement that happens towards the downside because now you have two sold calls to one bought call. Now, the drawback in doing this is if the bias remains on the upside, you're going to have a straight sharp move on the upside, and this would create trouble and your bullish strategy won't really make any money. To further combat that, we buy the 22,900 call of the 23rd May expiry. What this does is it hedges the extra sold call, as a result of which if the markets go straight up, we face no difficulty and the strategy makes money. So just outlining the strikes once again, we buy the 22,500 call, we sell the 22,650 call, we sell the 23,000 call, all of 30th May expiry, and we buy the 22,900 call of 23rd May expiry, a modified call butterfly on the bullish side.
Right. Rahul, if you could also take us through the most amount of loss that you can make in your strategy and the potential benefit that could come through.
So the beauty of any strategy where you use multiple expiries, and if you use them well, it always curtails your loss to a great extent. So the maximum loss in this strategy, depending on where Nifty opens today, would be approximately 900 to 1100 rupees, 900 being based on current market prices. So if Nifty does not go in your favor, that is if Nifty does not go up or Nifty does not remain sideways, you would lose a maximum of 900 rupees. The maximum reward on the other side is 3,200, which is quite significantly higher than the risk. So from a risk to reward perspective also, it's quite handsome. It's about 1:3.5 in terms of risk to reward.
And the horizon that we're looking for when it comes to this specific strategy is over the course of the next 3 to 4 sessions. Am I correct?
So the horizon would be up to 30th May. The only change would be that on 23rd May, assuming that that expiry comes about, you would roll over that strike from the 23rd May expiry to the 30th May expiry. Having said that, even if the market moves one side by 23rd May, then too this strategy will be profitable because the second sold call is coming after my bought leg, and hence the strategy is fully hedged.
Okay, so I reckon that is another crucial pointer of potentially rolling on the 23rd May call as well, should, of course, you be benefiting from that expiry and moving on to the 30th May one as well. Well, a fairly defined, well-defined strategy there as far as the Nifty is concerned, with a very favorable risk and reward ratio as well. Rahul, I just want to perhaps follow up with any stock recommendation that you have in terms of an option strategy out here?
So last week, if you remember, we discussed IDFC above 115. Sadly, that level never came about. This week, we're looking at Persistent Systems. It had a good move yesterday. The current market price is around 34.80, if my memory serves me right. We're looking for a buy above 35.50. It's very important we follow these levels and not get stuck wherever there is no momentum. So above 35.50, once again, we plan a simple bull call spread. What we do is we buy the 3,600 call of the May end expiry, and we sell the 3,700 call once again of the May end expiry. The advantage in doing so is, once again, there is lower debit involved in this because you're buying a call as well as selling a call. And the also other added advantage of doing this is that you're in a stock which has momentum on the upside. So above 35.50, we would do that. The current prices of 3,600 and 3,700 are 60 and 37 respectively. It has a lot size of about 100. So the risk should pan out to be somewhere around 2,500 rupees. And the reward can be in excess of 100 rupees. One point here to keep in mind over here is that always make sure that you have enough time for the trade to play out. So if this trade does not trigger today or does not trigger tomorrow, then I wouldn't suggest taking it for the next week because the number of days to expiry would be less and we wouldn't have enough room. Then I would suggest switching to June expiry, assuming the legs are liquid, of the same 3,600 and 3,700.
Right. Right, fair enough. Rahul, we'll leave it at that. Thank you so much for joining us and taking us through your views in the markets and, of course, helping us with those strategies out there. Well, that's Rahul Ghosh of H.in. With that, it's back to you in here.
It's okay. You can toss to any of us.
Yeah. One of you then.
That's fine. All right. Thank you for that.
We get penalized if you get the names wrong.
Yeah. Amit Dikshit is with us, analyst at SRRA, ICICI Securities. Amit, very good morning to you. We wanted to talk metals with you and the fabulous run-up that we have seen in metal stocks overall. First of all, do you think that there's a fundamental shift that we're seeing? What are the reasons for this? And do you think that this is now a turn in the commodity cycle that you will see sustaining?
Yeah, hi. Good morning for having me. So I would actually like to move beyond the prices that a lot of us are enamored with when it comes to commodities. So if you look at the on a steel side, what we are seeing in India is a change which is not appreciated by many at this stage. The change being that India is now the driver of global steel incremental production. See, China will still remain the largest consumer and producer, but the incremental production that I'm talking or consumption that I'm talking about is something which is important because that drives the markets. So if I look at Indian steel consumption, that is going to be 2x of what it was in FY23 by FY32. So you are really looking at a 9-year, 10 years horizon where the consumption will double. Now, to back it up, what we have seen that in FY24, for the first time, ever, the domestic steel consumption has grown in double digits for 3 successive years. And FY22, 23, 24. 22, of course, you can, pin it on COVID base, but 23 and 24 steel consumption growth was on high base. In terms of incremental steel consumption, what we believe is that that India would be consuming from CY20 to CY25, as per the World Steel Association estimates, the incremental growth in Indian steel consumption would be 66 million tons compared to 24 million tons growth globally. And China, on the other hand, is going to decline by 120 million tons in the same time period. So these are significant numbers and shows the paradigm shift that Indian steel companies have made over years. And by FY30, you will be finding that Indian steel companies would be as big as global majors. JSW Indian steel capacity could be 50 million tons, Tata Steel 40 million tons, JSPL in excess of 20. So we are seeing a great shift, I would say, where the bigger players are becoming even bigger and growing. While the smaller players also, not to be left behind, the infrastructure segment is kind of growing. So they will also have their own fair share. So that is our thought process on steel. And in ferrous space, our topic is general stainless, followed by JSPL, followed by JSW. Right. Now, as far as non-ferrous is concerned, this sector or segment is more prone to macro risk because LME prices are traded on exchanges. We are more constructive on aluminium here, and therefore our topic here is Hindalco with a target price of 840, of course, led by the resurgence in Novelis that we are seeing.
Amit, of course, one piece of the puzzle is the consumption story, the aggressive capex investments that some of these big players are making, expectation that the government will, of course, do a little bit of intervention to protect these players, keeping everything else in mind. On the other side, like you alluded to the fact that LME prices are also critical. And let's not forget that China is waking up now. There's also a sense that there could be a rate cut coming in the US, which of course means a weaker dollar, also means higher commodity prices. Is that enough reason to pick up everything else that's available right now? Because some of these stocks have started running up in the last few days. Timing-wise, do you think we are well-timed to go out and acquire these counters? Do you feel like the commodity cycle will extend into into FY25?
See, China, I would say that it has confused people a lot since COVID or even before COVID. Nobody can say that when and how much they will do. What we have seen that because of the high debt GDP ratio, the endeavors at actually boosting economy, stimulating its economy have been little bit underwhelming. Also, the fact is that in China, the goal is now a very, I would say, communist kind of goal, which is common prosperity. Whenever inflation rises, they tend to curtail stimulus. So I won't be, kind of basing my argument on that. If China wakes up, as you said, it is another tailwind, and of course, LME prices get a boost from there. So definitely, that's an additional tailwind that we have. But I would reckon that, in metal space, what happens that whenever the boom is led by prices, just about everything rises. But, we should be able to separate the grain from chaff. And therefore, I would say the important point is here to pick good counters. So therefore, in non-ferrous, our top pick remains Hindalco.
Right. Also, just very lastly, do you feel like a lot of those gains could be bulked up? Because the next couple of quarters, infrastructure players have indicated to us that the pickup in business might be slow because of elections. You also have a heat wave going. Construction workers are not working for extended periods of time between 11 to 4 as well. Do you think all that will mean that sustainable uptick in demand will come in post the first 2 quarters of FY25? Or do you feel like a lot of that is already witnessing a pickup as we see it? You talked about Hindalco in the same breath being a top pick. Anything else, top 3 picks across the sector would also be helpful for our viewers, keeping the valuations in mind and earnings, of course.
Yeah, of course. So, just to put a perspective to it, it's the election period, as we all know, and things rather go slow. Now, over the high base that we have seen in FY24, domestic steel consumption actually grew by 9.4% YOY in the month of April. So I think that's a good data point that suggests that demand on ground, might not be weak. So the infrastructure that we are talking about is basically countrywide infrastructure, but the statewide infrastructure is still up and running. So if you talk to some of the secondary steel players who are more local in nature, you will find that the secondary steel value chain as well as demand has gone up. Shah Metallics, for example, reported the record level of rolled product sales in Q4. And the outlook also is good. Now, having said that, if you ask me the top 3 picks in the segment, well, I would be still glued to ferrous, and the top 3 picks will remain Jindal Stainless, followed by JSPL, and followed by JSW Steel. In the mid caps, we will definitely recommend Shah Metallics because of the upside that it provides. See, valuations, I would like to add, is a function of ROE as well. And what we are seeing that the incremental capex that is coming to the country by all the steel companies, while it might look aggressive, but if you look at net debt to EBITDA and compare it in the last decade, FY12 to FY20, or even if you go to FY21, you will find that net debt to EBITDA of steel companies, or for that matter, non-ferrous companies, routinely used to be between 4 to 5 times. And now what we are seeing, it is less than 2 times. So this net debt to EBITDA leverage going down, your consumption looking good, and of course the ROE is looking better than ever before. So I think these are the 3 key ingredients for a valuation upgrade.
All right. Thank you so much for joining us today. That was the call on metals. But what is the setup for markets? Let's take a look at that. Shrikant Chauhan, Executive VP and Head Equity Research, Kotak Securities, with us today. Aditya Shah, Founder, Hercules Advisors, also joining us. Welcome to both of you and very good morning. Shrikant, I'm going to start with you on the levels. And, 22,200 seems to be a sort of a resistance level, a sore point for the Nifty, difficult to sort of break out. Looking at yesterday's trade, which was at the end of the day range-bound, volatile, would you say that we are set for an upside today or more choppiness in store?
Good morning. Good morning, everyone. I think, under the leadership of US markets or global equity markets and positive global macros, we are expecting our markets to do well. 22,000 is certainly going to act as major support in the medium term, but in the near term, if we see the entire structure of the market, then it is into pullback to the recent sell-off that we saw from the levels of 22,800 to 21,800. We are expecting market to move towards 22,500 in the near term, and today, on the dismissal of 22,300, we can expect some short covering and upward rally towards 22,500. So 22,300 is going to act as major resistance in today's date. It's a resistance of 50 days as well as 20 days simple moving average. So yesterday also we saw some profit taking from those levels, but on the back of specific positive global macros and the way FIs have their short positions on the market, we are expecting upward activity in the near term. In case if there is any correction, then I don't think that the market will break the level of 22,200 so easily. So broadly, we are positive and we should look for adding some long positions. For the bank Nifty, there also we are expecting upward activity because most of the private banks have recovered in the second half yesterday. Above 48,000, we can expect technical breakout.
So, that's the call on Nifty and Bank Nifty. Shrikant, I just want to start off with your top picks today.
Yeah, I think in the overall bullish setup of the market, we should look for adding those stocks which are really strong in terms of their fundamental news flow as well as technical formation. And in that, we like ICICI Bank, which is currently around to 1125, 1130. From here, the stock can move to the its previous all-time highest level of 1160.65. So it's a buy at current levels with a stop loss at 1105 on the downside. The other stock which we like is Gravita, which is currently somewhere around 945, 950. It is also from the metal space. It is into recycling of several commodities. So that particular stock is also looking very strong on the charts because it is forming some higher top, higher bottom series. Based on that, we are expecting stock to move towards 980 or 1,000 sort of levels. At these levels, it's a buy with a stop loss at 920. So risk reward ratio is again favorable for Gravita.
Okay, let's just pull up those stock recommendations once again. Shrikant, you can just give us those levels if you can once.
Yeah. For ICICI Bank, the target is around 1165.
1165. Okay.
Stop loss, we need to keep around 1105. Currently, it is at 1125 levels. And the other stock which we like is Gravita with a target of 980 and 1000. These are the two targets because it's a mid-cap sort of company, but the formation is quite strong and fundamentally also the stock is doing well. We can keep stop loss at 920 for the same.
Okay. Yeah, just wanted those levels out of the way. So one large cap and one mid cap, ICICI Bank and Gravita. Those are the ideas from Shrikant. Well, let's talk about Bharti Airtel. Speaking at the earnings call, company's MD and CEO Gopal Vittal said that the architecture of mobile data pricing in India is broken due to the existence of unlimited data plans. A lot of people have views on this, but first let's listen to what he said.
Unlimited plans, I mean, I agree with you. I think I've mentioned this before. I think the architecture of pricing in India is quite broken because people who can afford to pay a lot more are paying a lot less simply because of these unlimited plans, which are like, effectively a one-size-fits-all plan. If you look at markets like Indonesia or Thailand or any of the markets in Asia, you'll find small, medium, large, extra large, and there's a pathway to upgradation. That unfortunately is not the case in India, but this is not something that we can do alone.
Well, I don't mind the unlimited data plans, Mr. Vittal, I must tell you that. And it's something that's given by the telcos by choice. It's not something that the client is asking for. At some point of time, you will go and raise prices when you want to. Until then, you go ahead with the market diktat as it is. It's a free market for you to price the way you want and for me to choose the way I want.
What I didn't get is, and just to underscore the point you're making, Niraj, Who is stopping a Bharti Airtel from raising prices today if they feel that customers can pay? It's a dynamic market. It is not controlled by any government entity. Increase the prices and see what happens. The fact is that it's a two-cornered market and there is a pressure from competition. So what are we going to do about that?
And the customer will complain, yes, but the customer can't do anything if tomorrow the prices go up, which they will at some point of time over the course of the next 3, 4, 5 years to a particular level. At that point of time, none of the telcos are going to come and say that, oh, the customer is getting pinched, so therefore we are going to go to reduce the prices by 200 rupees. So, well, it's a free fair market. You price it the way you want.
It's a largely a duopoly, actually. Largely a duopoly with one player hanging on. So,
well, Aditya, telcos, without getting into the morality of the argument, but I mean, maybe you can dwell on that too, but the question really is, are you constructive on Bharti Airtel as a stock or even Vodafone Idea for that matter, which comes out with results today?
Good morning, Niraj.
Very good morning.
The results from Bharti Airtel were okay. And I feel that over the next 1.5, 2 years, both Bharti Airtel and Reliance Jio will embark on a price hike simply because the 5G capex is really coming about, and both of these companies really need money to invest back into infrastructure that will sustain our digital economy for the next 5 to 10 years. So in my opinion, price hikes are coming whether we as users like it or not. Maybe after elections, when the budgets come out, after that, the companies are going to hike numbers. From a stock perspective, as Tamannna was also saying, now it is a duopoly where Reliance Jio and Bharti Airtel will dominate the market, and Vodafone Idea will only do well if there is a big package from the government where they try to have an investor who comes and invests in a big way, and the debt on the books of Vodafone Idea gets some reprieve. So in my opinion, most retail investors need to avoid Vodafone Idea. Bharti Airtel and Reliance Jio, Reliance stock for that matter, both of them look good. Both of them are one of my top picks within the sector.
That's the fundamental view coming in on the telecom space. Shrikant, have you been tracking these Adani stocks? Last few days, the rally has been phenomenal. Adani Enterprise is up 6% in the last 2 days. Adani Ports has done well. Adani Energy as well closed at a day's high yesterday. On the charts, is there a trade on any of the Adani stocks?
Yeah, I think so, like whenever there is a rise in the week's volatility index, we try to track those companies where there is like good amount of momentum. Like PSU stocks or maybe Adani stocks. Most of the time, whenever there is activity in the market, we see high beta sort of activity in these companies. In that particularly, we like Adani Ports as well as Adani Enterprise. The reason is because in these two stocks, there is good amount of liquidity, and whenever there is a price action, we see very strong upward or downward activity. Specifically, Adani Port looks good because it is going up gradually. It is around 1337. Since the last 4 days, it is inching up. Yesterday, there was some consolidation, but 1340 is 1360 is acting as major resistance for the stock. On the dismissal of 1360, we can see the levels of again 1400 or 1420. So Adani Ports looks strong candidate to buy for. Decent candidate to buy at current levels around 1337, 1340. We can keep stop loss around 1310 for the same, and 1400 or 1420 is possible. For Adani Enterprises, I think it is better if there is any correction, then there we should look for taking long bets. Close to 3000, 2975 levels, sub 3000 levels, it has very strong base of buying. So there we should look for adding positions on dips. We are expecting stock to move again back to the levels of 3200 or 3300 in next few days. So Adani Enterprise as well as Adani Ports should be on the watch list.
Okay, and standard disclosures there of the Adani Group, which owns NDTV, and you're watching NDTV Profit. Now, just another stock that we want to talk about, Colgate Palmolive. That stock had a hammering yesterday despite very good numbers. Now, I had a chance to sit down with the CFO of the company, MS Jacob. Listen to a short excerpt of that conversation and what he had to say on the company's growth margins in the fourth quarter.
Yeah, I mean, our margins have been on an upward trend, and pricing is obviously a key driver, as in prior quarters. But what's happening is also we're seeing input prices have started moderating, and in fact, we've seen reduction also in some of the materials. So between the two factors, the margin has been up. Of course, it's a bit softer, the gross margin, than the full year levels, but very encouraging nonetheless.
All right, so that entire interview you can watch at 9:45. I just want to pull up the pre-open rate for Colgate Palmolive. Like I said, that stock got completely hammered yesterday despite its highest ever margins. Maybe the gross EBITDA margin figure was an issue. Nomura note this morning talks about how higher ad spends may be making them a little nervous, but that stock doing okay in pre-open rates. The first pre-open rates are also out, and while we wait for them to settle, no big standouts right now. Just in Adani Ports, I would pull up doing fairly okay. Bajaj Finserv, LTIM. That's the kind of mood that we are seeing, but no big moves, at least in the first couple of minutes. We'll, of course, wait for all of that to settle as we go forward. United Spirits having a good morning, so is GE Shipping, Hindustan Zinc once again doing fairly well. But again, we'll give it a couple of minutes before we get to those. I wanted to actually get Aditya, your view on a Dixon. How do you see a Dixon panning out? Numbers look good on the face of it, slightly shy of what estimates of the street were, and a very, very positive outlook. For a stock that has already seen such a massive bump up, do you think that you would be constructive on a Dixon right now?
So manufacturing is a theme for the next 5, 10, 15 years. As this government comes in again, which we all expect they will do, manufacturing again through the PLI scheme will get a big boost. Having said that, this theme has run up a lot, and stocks are really very expensive. As with Dixon Technologies as well, the results are good. The commentary is also really very good. But the stock is really, really very expensive, and any in the future could mean that the stock could really correct. So I would suggest that be really very careful on the stock. If there is any good correction, only then to add this stock. However, in the shorter term, try to avoid this stock. But manufacturing in India as a theme looks really, really very good and very interesting.
Fundamental view coming on Dixon. The Nifty in pre-open is about 22,300, and that seems like a little bit of relief. No runaway gains just yet, but 0.5% higher on pre-open is actually not a bad start. A quick check on our Bank Nifty is also looking like in early minutes of pre-open. Unchanged for now is what we have. But lots of stocks will be in focus. I remember stocks like Berger Paints, which reported numbers, Dixon Technology, Colgate Palmolive reacting to what the management is going to say is going to be one to track in early trade. Bharti Airtel post the con call yesterday are going to be some stocks that you want to keep an eye on in today's day of trade. Bharti Airtel is up 2.6%. It's actually not a bad start, or eyeing not a bad start this morning. Shrikant, on the defensive names, let's pull up HAL, BDL, Cochin Shipyard, Masgaon Docks. The rally there is unstoppable, and the defense secretary only helped it further a few days ago. On these names, even though the rally has been phenomenal, do they still look attractive for the medium term, or for maybe the May series?
Yeah, I think, see, broadly the sector is doing well. Whenever there is a correction in the market and in the sector, we are seeing good amount of buying interest in almost all the stocks, and most of the stocks have crossed their previous highs whenever there is a rally. This time also Hindustan Aeronautics did really well. Now, based on the overall setup of all these stocks, we specifically like Cochin Shipyard based on its technical formation, and also we like Bharat Electronics. But if really I would like to go with any one stock, then Cochin Shipyard looks really decent bet to buy for. It is around 1330 levels. Based on its volume, based on its weekly and monthly formation, I'm expecting stock to move towards 1450 or 1500 sort of levels. It's a buy at current levels around 1330. we can keep stop loss around 1280 for the same. So keep little bigger stop loss for buying such type of stocks because they have very high beta. But broadly, we are positive on the space based on their technical formation.
As the pre-open rates are settling down, by the way, amongst the top stock losers is something that Samina highlighted at the start of the show. Jindal Stainless down about maybe 8-9%. NLC is the other one, which is correcting 7%. And while Redington and Honeywell are also off, I also want to mark specifically RT Industries. Second day on a trot now, down about 3%. This is despite the company guiding to nearly 40 to a 70% jump in EBITDA for FY24 over FY25 because of valuations being slightly expensive. I think it was the UBS note yesterday which said that RT should trade at a lower valuation too because it is an expensive stock. And for 2 days on a trot now, RT Industries is certainly starting off weak. Speaking of, and by the way, on the flip side, Mankind, Titagarh and Apollo Tyres on the brokerage notes is doing very well. I wonder if Harsh has picked up Apollo Tyres as one of the key brokerage notes, or is it something else? Harsh, good morning.
Hi, good morning, Niraj. Yes, Apollo Tyres is on my list, but let me first off cover Morgan Stanley on Adani Ports. Continues to remain bullish. In fact, they believe that their estimates for FY29 need to be revisited, need some amount of a revisit on the back of the 5-year plan being ahead of the estimates that they have based their numbers on. In terms of what the 5-year plan seems to indicate, well, 1,000 MT in terms of FY29 expected target volume. They're also expecting port revenue to double and EBITDA also to double. So ROC, they believe, of all major ports is targeted to be above the 20% mark by then. The logistics revenue and EBITDA growth is likely to be pushed further higher, and their consolidated revenue, EBITDA and free cash flow target growth is expected to be 2.5 times and 2.3 times for the latter two, which is EBITDA and free cash flow from the current levels. Of course, there are risks to the downside as well, specifically volume growth if slower than expected, more intensity with regard to pricing competition, value dilutive acquisitions could also play a spoil spot, and an increase in related party exposure. That may also play a bit of spoil spot. Those are risks on the downside. That's Morgan Stanley. Quickly moving on, Nomura on Apollo Tyres. Q4 results were largely below estimates according to them. They were impacted by lower revenue. That's one. Second is extended producer responsibility provisions have gone up, which is what has impacted the numbers. Now, Q4 volumes were marginally higher. You are also seeing market share gains, especially in the replacement segment. Rather stable numbers overall on that front. But the focus on profitability over market share likely to have a tepid impact with regard to the top line number according to Nomura. So only a 6% growth projected by them on a CAGR basis to FY26. But price hikes and focus on better mix should improve margins, hopefully, is what they are believing, and margins could normalize at the current levels, which is FY24 levels. Free cash flow generation likely to remain strong all the way through FY26 is what they believe. But the upside here, and that's where they've changed their rating, they've upgraded, is on the 14% decline in the stock price over the last 2 months or so versus a flat index. And therefore, they believe there could be a possible upside, and therefore they've upgraded to a neutral, 512 being the target price.
Right, a couple of other stocks that have reported numbers that will be in focus. So we've highlighted Jindal Stainless, NLC, Mankind Pharma, Berger Paints, Precall, Titagarh, NLC, Redington, CMS, Somani, Moil, IEX, NCC are going to be stock reactions that you want to be tracking in today's day of trade. Apart from that, you've also seen Dixon that is looking flat. Their margins have been under pressure, and that's one stock that we will track from the get-go this morning. We've talked about a whole bunch of names from the frontline stocks, but technically and fundamentally, let's get a view in on Tata Motors. Aditya, Tata, after its reporting early this week, has been on the sell side for the last few days. No meaningful recovery yet in sight. Do you feel like the run for autos is now done with, or is there still an opportunity and current weakness maybe a good time to accumulate in a staggered manner some of these auto names?
So the guidance that Tata Motors really gave, that was really weak. And on the back of that, the Tata Motors stock is really correcting. In my opinion, the stock has run up from about those 200, 300 levels right up to the 1,000 levels. And it is not really cheap. In fact, it is even more expensive than Maruti, which dominates about 50% market share on the back of the EV investments that they have done in India. So in my opinion, for Tata Motors, you just need to wait. If you have the stock, you can continue to hold the stock. But I would not advise any new fresh investments into any of the OEMs. We are undergoing a big change from a petrol engine, from an internal combustion engine to a EV. And we just don't know who is going to win. Although Tata Motors has made huge investments and the Nexon and other EV products are doing really well, but this is a big change and we really don't know how is it going to pan out. So I will try to invest in auto ancillaries where they are agnostic to EV changes. For example, the battery players, or for example, companies who have already been on the chemical side of it, where battery chemicals is something that looks really very interesting. So for the time being, I would like to avoid very expensive OEMs and try to concentrate on the ancillaries and the chemical players who are supplying on the EV side.
Interesting point, because the whole impact of the new EV policy has not yet been digested and is yet to unfold for the market. The new EV policy, which allows imports, of course, with a Make in India peg. So you have likes of a BYD, a Leap, etc. coming in. We have pretty much just a minute to go. Shrikant, any top call in just 10 seconds before we start?
Yeah, I would like to go with Power Finance Corporation. The reason is because the stock is again forming some reversal activity on daily basis, volume expansion. Overall commentary from the management was like good. Technical formation is indicating us that it is heading for the levels of at least 470, where it has left bearish gap. So at current levels around 445, 446, it's a buy with a stop loss at 430, and we are expecting stock to move towards 470. In fact, PFC as well as REC, both are looking good, but PFC is relatively better.
You know, I'm gonna ask this question to Aditya post market open about whether PFC is relatively better on the valuation front, because it trades at, if I'm not wrong, about a third of a discount, or at least a 25% discount to REC valuation. So can these loan growth guidance numbers and this relative discount aid PFC in its move? I don't know how closely Aditya tracks them, but of course we'll talk about that. But 14 seconds left. Remember, Asia has done very well today. US markets had a good handover too. So the global scene is looking okay. We don't have any negative cues per se. Windfall tax cut, maybe that impacts some of the oil companies too. So lots to talk about on market open. Let's see how they're starting off. About 90 points, so pretty much in line with the implied open, but 22,300. Remember, the first point of key resistance comes in only at 22,500 or thereabouts. So let's see if this move takes the indices higher towards those levels or no. Bank Nifty, is it sustaining above 48? No, it's not quite there yet, just 0.5%. Let's see if there are more longs coming into shape or no. IT is the one that I'm interested in because tech, REITs, etc. could all do well. No surprise, Nifty IT is up about 1%. Just the nature of the reason of the move yesterday in the US market should have led to this. I believe some of the REIT stocks could also be doing well. We'll get to them. Let's get the heat map up on the screen. Actually, mid caps and small caps, if we can, very quickly before we get to the heat map. Mid cap 0.5%, small cap index about 0.5%. Let's get the heat map up on the screen. Bharti Airtel, brokerage upgrades out there. Firstly, lot more green, very little red. Bharti Airtel, brokerage upgrades yet again. Another 1.5% higher for that one. Remember, it ended almost at the day's high yesterday, 2.5%. But the major part of the move happened in the last half an hour. Another 2% there. LTI, Mindtree, HCL Tech, Infi, Wipro, IT right up there. Mahindra and Mahindra ahead of the numbers is up about 1.25%. So that's not doing too badly. Adani Ports, brokerage is upbeat, at least Morgan Stanley is, because of the FY29 guidance. That adds another 1% to its weightage. There is strength in ICICI. HDFC Bank, the top loser yesterday, also marginally in the green. And more importantly, no losers or hardly any losers. So not a bad start, not runaway gains for any stock, but IT plus some others really combining to give that little bit of an impetus that we need on open.
The opening is seeing the spillover of what we saw in U.S. markets yesterday. So you're seeing those positive cues coming in undoubtedly. Let's take a look at some stocks and how they're doing in the broader market. Specific stories they're driving the flow. Jindal Stainless is the first one that we'll pull up this morning, and a lot of it, of course, based on results and how the street is digesting results. So 5% down on the back of weak earnings as far as Jindal Stainless is concerned. Not too surprising there that you would have that kind of a number. I want to see what Dixon is doing, because Dixon, on the face of it, good numbers, nothing too much to cry about. It did miss estimates, but Dixon's doing well. Remember, very, very positive commentary from the management. Some of their big collaborations will come into play in Q1 of FY25. So 1% up right now. Berger Paints, Titagarh, NLC. Let's take a look at what the result impact has been. Berger Paints just flat, nothing great happening there either way. Titagarh is one which I want to see as well. Margins a little squeezed, but that stock doing fantastic in morning trade, about 7% up right now. NLC had a disappointing Q4, and that's reflecting in what you're seeing in terms of the stock performance. Right at opening trade, down about 5%. Mankind is the other one that I'll pull up, and as Samina was mentioning, the strong export numbers may be a boost. You're seeing that reacting well. And Apollo Tyres with a set of brokerage calls, which is redeemed the kind of first reaction to their numbers that we saw. 6% up on Apollo Tyres. So at least Apollo Tyres is having a good morning. So though the market breadth is positive, I don't know if there are too many big movers, Samina, this morning, and a lot of reactions just to the numbers, isn't it?
Yeah, and I just want to quickly mention the two listings we had yesterday. So let's pull up Aadhar Housing and TBO Tech, both those counters. Aadhar is having a pretty good morning, actually, 7.5% higher this morning. Remember, yesterday was not as good for it as it was for TBO Tech. TBO Tech trading flat, but Aadhar seeing a 7.5% uptick in morning trade. Tamannna has highlighted a whole bunch of earnings sectorally as well, barring IT and real estate that are up slightly, doing better than the benchmark. Or other broader markets. A few other sectors that are holding out this morning is actually a little bit of gains coming in for the oil and gas pack. You've also got healthcare that's turned negative. Real estate is not doing too badly. Pharma, PSU are trading flat with a slight bias towards the upside. A quick check on the VIX before we highlight for you what else is moving across the broader markets. The VIX is unchanged this morning, holding on to levels of 20 for the last few days. In terms of stock movers, we've mentioned to you how some of these earnings have stocks have reacted to earnings. On the sense side, Honeywell Automation is topping the list. Those numbers didn't look too bad, to say the least. In fact, you had a couple of the big brokerages also re-trading a buy call on them. Nomura, case in point, but the stock has responded very badly to its earnings. It's down about 5% as we see it. NLC and Redington are the two other reportees in terms of earnings, weak set of numbers. Somani Ceramics, if I can get that one up, numbers were okay, but a very strong buy call came in on the counter from one of the brokerages. The stock is doing fantastic, 15% uptick on this one, and expected to go to levels of 915. That's at least what Citi expects on Somani Ceramics. 16% on the counter is what we have. Let's pull up Pitti Engineering as well, TCI. Those are the few other ones that were in focus. Pitti Engineering, 5% up move, so good going for this one too. A quick check on TCI and CMS. Those counters as well reported numbers. TCI is flat. You've got CMS that's up about 1.5%. But so lots and lots of earnings. MOIL, that was the other one that reported numbers. Let's take a look at how that's doing. Should be useful to get a sense. It's down about 2%. Numbers weren't great there. TBO Tech started flat, but now trades slightly higher. Oberoi has reported strong numbers, and the brokerage upgrades continue to flow in. 2 days on, the stock is up another 3.5% this morning in trade. Niraj is looking at me, and I can see from the corner of my eye. So please tell me what it is.
Aadhar Housing, just that one, because Akash Bansali bought that stake,
that could explain the 7% up move in trade. But yes, that's Aadhar Housing, and TBO Tech, of course, had a stellar opening yesterday. Continues to trade marginally higher as we see it. Apart from that, KPIT Tech, Akyan, the numbers were a bit of a disappointment, recovered from the day's low point yesterday. And this morning, you're very obviously seeing low-level buying that's emerging on the stock. Valuations are compelling. I know bromine prices have declined quite sharply, but the stock, of course, on back of attractive valuations, is seeing a little bit of play there this morning. Hutco is also not doing too badly. IEX reported numbers. Let's take a look at how that one's doing. It's largely been an underperformer in terms of stock. But yeah, this morning, not too bad. 2.5% higher is what we have. Tech is doing okay, like Niraj said. The likes of a KPIT also holding up quite well. M&M is seeing a little bit of excitement this morning ahead of its earnings. We'll watch out for how this one does in terms of reporting. Auto clearly been on the sell side, or rather Tata Motors on the sell side. The rest of the auto pack has not done too badly in the last few days. So that's it, guys. But I think Somani is one that stands out. Smaller name, but 15% uptick on that one this morning. Numbers were not so great, to be honest. They were largely in line. But I think, 16% now in Somani is what we have.
Yeah, it's done really well for itself, must say. Just opening thoughts before we get in our next guest. Just the opening thoughts. And I know I want to ask Aditya about the PFC REC thing. So before going to Shrikant, Aditya, just come to you. If you look at these closely, does PFC have the chance to catch up with REC on valuations? Does it open up upsides after the guidance that they've given?
For PFC, we need to understand what is happening. The government is cleaning up the power sector slowly and steadily. And the premise for whole of that rally is that the asset quality for PFC and RSC and the loan growth for PFC, for PSC especially, will start to improve as the government invests very heavily in the power sector, as well as cleaning up of the entire power sector mess, which has taken about 5 to 10 years for them to clean up. So in my opinion, the whole rally is on back of that. Having said that, the stock is not cheap per se, but over a period of 5 to 10 years, I feel that PFC will do really well from here on as well, as the power sector continues to keep growing. So if you were to ask me a choice between PFC and REC, I would go for PFC right now at this stage, considering the fact that government is investing very, very heavily on the power side of it, and PFC will be the first beneficiary.
Shrikant, just wanted your take on M&M ahead of numbers, already showing a smart move. And if I were just to take the argument that Aditya made a short while ago about OEMs in general, saying let's stay away from OEMs, Auto Ank is where it's at. You think this M&M move is just sort of a pre-results kind of a move, or do you see more to it on the charts?
I think M&M is showing a lot of constructive activity. Whenever there is a correction in the stock, we saw good amount of base building, and later on we saw rally in the stock. This time also, in the previous week, the stock was consolidating, and in last 3 days, we saw a very smart upward activity in the stock. Based on its technical formation, I am of the view that it is heading for at least 2,500 in next maybe few days or weeks. So it will take some time, but broadly, I think the stock is heading for 2,500. It's a buy even at current levels, and more on dips, maybe up to 2250. There the stock is having excellent support. We can keep stop loss around 2200 for creating or holding any long positions. I think stock is doing really well.
Okay, Jama and both of you, thank you so much for taking the time out and being with us and giving us your thoughts. Really appreciate your time this morning. Well, it's just the right time to get in. Somebody who looks at slightly longer term conversations as well, Chandra Prakash Padiyar, Senior Fund Manager at Tata Mutual Fund, joins in with his thoughts on how to approach the current scenario. Chandra Prakash, great having you. Thanks so much for taking the time out. Hope all is well. The fears of last week abating have gotten a bit of a further leg up by virtue of what's happened in the US overnight with regards to inflation data. Is this conducive for a long-term investor to put in money to work if she or he was sitting on the sidelines?
So, hi, good morning. Well, long-term always is reasonable and positive from an India perspective. Having said this, I would want to probably highlight that given the pace of returns that investors have made over the last 3 years, back to back, it does look like, and where valuations are, when the earnings outlook is quite steady, it does look like that investors need to prepare themselves for lower than normal returns for maybe the next 12, 24 months. But to your question, I think yes, long term certainly does look positive, and the trajectory certainly looks positive.
Chandraprakash, is this, do you reckon that for emerging markets, they might latch on to the narrative of lower yields, possibly lower DXY strength, and that being conducive for markets? Whether or not Jerome Powell goes ahead and cuts rates is secondary. But the market belief that that might happen might just egg all EMs, including India, higher as a bucket?
Well, Niraj, if you notice, it is a global rally.
Yes.
It is not only an India rally.
Exactly.
And it is all flow driven in that sense. Because if you look at generally across the world, earning growth is in mid-low single digits or below single digits. That sense, barring India. So in that sense, it is not an earnings-driven rally across the world. India is an exception, maybe in that case. So yes, investors are positioning for, as of now, as we speak, for lower inflation, lower interest rates. So I do hope that there are no disappointments on that count. Fundamentally, though, looking at India specifically, there is one thing that I must highlight on India as well, which is that earlier, for the last 2-3 years, every quarter, every year, Indian corporates outperformed expectations from investors. So their earnings delivery was better than expected. I think we have already reached that phase where one, earning growth is not going to be as strong as what it was in the last 2-3 years, given the base effect. And two, expectations are running reasonably well now. I don't think there is scope for too much of positive surprise in India as well. And which is why I was saying in my earlier remarks that logically it looks like a period where we've entered, where given the valuation where we are, 1 or 2 months of rally if interest rates were to get cut. But I think investors should expect low returns going ahead.
Right. Investors should expect low returns going ahead. It's also Samina joining in, Chandraprakash, and I want to talk to you about earnings. Have you spotted any opportunities among sectors, especially after recent corporate earnings? And also, did the March quarter earnings meet your expectations?
So to that extent, so this market is all about stock selection now. It is no more about sector selection or top-down approach, more a bottom-up market. And to that extent, I think, yes, opportunities are there in all kinds of markets, and we've been able to identify quite a few of them. Having said this, I again come to a similar point, is that in 18, 19, 20, whenever we used to buy a new business in our portfolio, the risk reward used to look like 3x is to 1 or at least 2 to 3x is to 1. Whereas where downsides looked lower and upsides were far, far higher. Sitting today, when we buy a new idea, when we look for a new idea, yes, there are pockets of opportunities available, but the risk reward is no more 3:1. I think it is 1.5:1 or maybe 1:1. So that's the nature of the market today. But having said this, are there businesses available which are growing at a fast pace? Certainly, yes. There are quite a few of them across market cap, large cap, mid cap, small cap. But the only complaint that we have is that valuations have moved materially higher across. So you have to be even more diligent when you buy or sell something in your portfolio.
Right. Everything looks expensive, but I mean, India's always been an expensive market, one could argue. I want to quickly get a view on exposure to rural play. We are cognizant of a forecast of a normal monsoon, and I believe a lot of analysts, brokerages have gradually been reducing their underweight stance on the agrarian play. How do you feel about rural play? Is that a space you feel like there could be some value in and could be a good sector to bet on for the next couple of quarters or for FY25 at least?
So when we talk about rural, what has been missing in our markets for the last couple of years is B2C, which is consumer-facing branded companies. These are companies which have been showing lower volume growth a quarter. And these are the companies which have now started saying in the market that they are seeing rural growing slightly higher than urban. Having said this, growth is continuing to be low single digits on an overall basis. So yes, monsoon will be important, I think. Agri commodity prices are slightly starting to move higher globally. So that will be a tailwind for the agri sector, and hence probably income levels will go up in the agri side, and that could lead to higher demand. So we are, and the last thing is the way government infrastructure capex has been going up over the last years. The final impact, or it will percolate down to the rural segment, and that should hopefully lead to higher growth going forward. So we are also hopeful, keeping our fingers crossed. As of now, growth continues to be on the lower side, and which is now starting to get reflected in consumer valuations as well. So, on the one hand, you see capital goods industrial stocks zooming almost every day nowadays, valuations going to very high levels. On the other hand, B2C companies, valuations are either normal or going towards below normal in some cases. So if earnings were to pick up, I think that's where you may see surprises.
Since we're calling this the election trade, Chandra Prakash, hi, Tamannna here. I must ask you a question of whether you have any kind of doubts, positioning ahead of June 4th, or is it just a blip in the larger picture in your view? How are you looking at this event?
Hi, Tamannna. So as Niraj was saying, we are more long-term investors. So it's these events, we don't play for such events in our portfolio. Having said this, we believe that the economic outlook cyclically, from a trade perspective or real estate perspective, and structurally, which is manufacturing and other stories, continues to be on a strong trajectory. Means that if at all there is a sharp knee-jerk reaction on any untoward result on election day, or let's say next 1 month, we would use that as an opportunity to add into our portfolio rather than being negative on that.
Okay, so let me understand this. So even if there is an adverse result, adverse in perspective to what the market is expecting, you don't think it changes the long-term picture?
It doesn't.
Okay. All right. So that's fairly clear. Thank you so much for speaking with us. That's the election trade coming in, that in the big picture. And in the very long-term picture, perhaps June 4th is a blip on the radar, but for those looking at the markets on a daily basis, that becomes one of the biggest factors. We'll take a very short break, but don't go anywhere. We're speaking with Granules India on the other side on their numbers and more. Stay tuned.
Thanks, Back with India Market Open right here on NDTV Profit. In conversation now with Mr. C. Krishna Prasad. He's Chairman and Managing Director of Granules India. They've come out with numbers, which is one, but they've also come out with a guidance which seems to be pretty strong relative to what the street may have expected and relative to what they've clocked in the quarters gone by. Mr. Prasad, good having you. Thanks so much for joining in. Just a word on the quarter of the year, because I'm very interested in the guidance that you've given. But do tell us, because there's a lot of conversation about the Biosecure Act and what it does in FY25. There's a lot of conversation about how formulations may have done X, but API business has done something completely different, and they kind of negate each other as well. How do you map the quarter gone by?
Quarter gone by was, my opinion, it's been a great quarter, especially since it's been validating our trajectory. FDs have started growing, and in the last quarter compared to the Q on Q, we had a 41% growth in FDs, and that's exactly what we wanted to do. However, I cannot just downplay the fact that we got hit by paracetamol sales, which have really gone down. And that's been due to the excess stocking with some of our customers and overcapacity in the market. A lot of excess capacity has been created after COVID, and prices are at an all-time low. And in fact, prices have gone down, sale price have gone down by more than half compared to last year. But however, I see some positivity coming back on paracetamol as we go by quarter on quarter. But the main growth is going to come from formulations, especially driven by the new launches and also the new launches that happened last year, which are gaining a good market share, and also the launches that will happen during this year. We have about 14 launches lined up for this year, and we expect all this together, along with our products manufactured in our US facility. We manufacture a lot of controlled substances there. There we have a very good leadership position, and all this put together, we expect there will be a good uptick in the quarters to come too.
Yeah, this is also Samina joining in, and I believe the company is also betting big on value-added products, so new segments in oncology, backward integration. Can you tell me how much of this could potentially contribute to your top line in FY25?
The new launches, which are value-added, will definitely contribute a bit, not a bit, quite a lot. But the backward integration is still taking some time. We have some patented technologies which have been demonstrated at pilot level for APIs. And these will be, we are working on building up capacities. We will see these capacities come online only in FY26. And for this year, I don't think backward integration will add anything to
value added. Can you quantify that for me?
On the
oncology segment, yes, the value-added products.
It's not oncology. Oncology, we have about 4 products which are all P4s and possibly first-to-files. We are working on first-to-file possibilities. That's happening on oncology side, where we'll be integrated right from API formulations. We'll be doing everything in-house, and we'll be using our facility, which has been idle for quite some time. And in addition to that, we have many controlled substances which we have launched already, which we are planning to launch, where these are very high value-added products. It's a big move. I won't say it's a move away. It's an additional thing to our existing high-volume products. And this definitely is going to add a lot of value to us as going forward.
Mr. Prasad, while North America was positive, all other geographies, YOI growth wasn't the strongest in Q4. You have guided to, I believe, making a lot of new launches, as you were talking to Samina as well, particularly in the European region, if I'm not wrong. Does this bolster growth in Europe? Does it become a focal area of growth for FY25 for Granules?
Europe, we had on the formulation side about 45% growth in Europe itself. So while the new FDs, which I was always mentioning that we are getting approvals, we'll be launching them, have been going very positively. Europe has been a predominantly API PFI market in the past. This is the first time we are going in with FDs into Europe, and the fall in paracetamol. In the APIs, it's all made mostly paracetamol, API and PFI. That hit us badly in Europe and, of course, in LATAM and rest of the world too.
Okay. The other question is operational metrics and this guidance that you've given for 22-23%. That's relative to what you've done. I mean, the exit rates are good, but when I look at the year FY24, then FY25 looks very, very strong. So what leads to this? And because of this, is there? I mean, I may have missed it, but is there a revenue growth and a PAT guidance that you also given out for FY25 for the company at large?
No, revenue and PAT, we don't want to talk about it at this point in time.
Okay.
But definitely, EBITDA, we have been clocking 21, 22 in the past too. That's what we said, maintain. It's nothing new that we have been doing now. Only last year was a blip. And there were the reasons for that, cyber attack and paracetamol too.
Right. So we've talked about backward integration and the value-added products, and of course the fact that all of this will be, a lot of it will be on stream in FY26. Can you quantify the capex over here, and how would you look to fund this?
Funding is always internal accruals. I don't think we'll be taking any debt, and if little extra debt is needed, we'll always not leverage ourselves. Our debt EBITDA will be less than 1. And coming to capex altogether, we have about 600 crores lined up for next FY25, and that will be split between APIs and formulations, and also some key intermediates, which C0 will have a small share of this, where we are making DCDA, one of the raw materials for metformin.
Okay, so 600 crores for FY25, but I believe you said that, or rather, the estimate is that over the next 4 to 5 years, the capex could be close to about 2,000 crores, again, entirely by internal accruals, Mr. Prasad?
Yes, we do not want to go with a huge debt, except small things, says it will be internal accruals. And on the C0 initiative, where we spoke of green chemicals and green intermediates and green products, finally, we estimated 2,000 crores over a period of 4 to 5 years. But there we have been very little cautious and frugal. We are going in a stage gate manner. Right now, we have a pilot plant where we have demonstrated manufacturing of DCDA in a proprietary and patented process. And now that this is getting streamlined, we are planning to go in with a commercial plant. So it's going to go stage-wise, a little slow, but some of the investments will come into APIs that with enzymatic processes and differentiated processes.
Got it. Mr. Prasad, final question. Any inorganic moves outbound or inbound in the next 12 months?
I don't think so. We are very cautious. We don't want to. Yeah, it's all focused on organic right now.
Okay. No, the part 2 of my question would have been that there's a lot of, I mean, when we speak to global PE funds, there's a lot of interest from outbound companies for taking stakes or buying out firms completely. This has always been a talk in the past for Granules as well. I wonder if anything on the anvil in the next 12 months?
No, I definitely don't think so. We are at the exciting phase of our life in the company. So many things are happening, and definitely not.
Definitely not. Okay. All the best for the quarters ahead. Thanks for taking the time out and speaking to us. Well, that's Granules India. Strong guidance on margins, no numbers given per se on top line, bottom line, but management sounds confident of some numbers perking up in FY23. Let's see the stock lying absolutely flat. Time for a break. On the other side, we'll get you a conversation with Colgate Palmolive CFO MS Jacob talking about Q4 earnings and more. Stay tuned.
numbers coming in from Colgate Palmolive. Very strong Q4 and above street expectations for the most. What's really interesting from the commentary from the management and in the post-earnings con call, etc., is two things which stood out. Rural has outpaced urban in this quarter. That's a trend that we've seen across the FMCG space as well. Your margins have improved as well, so that's been quite robust. To get more sense of the quarter gone by and the outlook for the next financial year, I'm speaking now with M.S. Jacobs. He's the CFO of Colgate Palmolive. Mr. Jacobs, welcome and thank you for speaking with us here at NDTV Profit. Great to have you on.
Thank you for having me.
Yeah, absolutely. So now you've hit your highest ever EBITDA margins at 35.7% in Q4. I'm trying to understand what has been the biggest contributor to this. Is it largely just a reduction in raw material costs?
Yeah, I mean, our margins have been on an upward trend, and pricing is obviously a key driver as in prior quarters. But what's happening is also we're seeing input prices have started moderating, and in fact we've seen reduction also in some of the materials. So between the two factors, the margin has been up. Of course, it's a bit softer, the gross margin, than the full year levels, but very encouraging nonetheless.
That's right. So Q4 was relatively softer. Of course, the full year's picture looks robust. What is the reason for that softness in Q4? Anything specific that we've missed out? Is it higher advertising promotion cost or something else?
No, I mean, there has been a moderation in margins quarter on quarter, and, we hit record gross margins in Q3, 72 plus levels. We don't expect to hit those kind of margins. So this is just a normalizing of the margins that we should expect.
Okay. So a higher base effect in a sense. What is the kind of outlook that we see for Q1 FY25, and if you have some kind of a picture for the year? Because I'm trying to understand if your raw material softness is going to sustain and if you see some of these factors sustaining.
So we continue to see it's quite benign, the input price increases, and also, combined with the cost savings program that we have called the Funding the Growth program, we expect to offset any increases that we are likely to see in the next few quarters through the cost management programs. So, we are not targeting any particular level of margin increases. We believe we are in a good sweet spot right now. It gives us the room to invest behind our brands, up the advertising, invest behind superior products and technology. So it does give a lot of room to us, and our objective this year would be to capitalize on that rather than target any definite increases in margin levels.
Okay, so we're seeing margin growth steady at the same levels?
Yeah, I would say by and large, current levels of gross margins. EBITDA would be a bit up and down because we would calibrate the advertising investment, given one, there is momentum building in the business on the oral care side, and we will continue to lubricate that side. And we've also referred to the emphasis on growing Palmolive. We've put new ads on air right now, so we're going to continue to back that. So that is the piece that will stay variable depending on the quality of advertising, the response to the advertising we put out there, the plans we have for the personal care category, etc.
So your advertising, for example, was up 20% for this year. Do you see that increasing in any substantial way for the next financial year?
Yeah, I mean, it would all depend on how the market or consumers react to what we are putting out there. Just a target on advertising number itself may not be the right one to call out. It would need to be really productive advertising. Our biggest objective is the top line growth piece. And, that's one we are really focused on more than anything on the P&L right now. And if it needs a higher level of advertising investment, we would definitely be willing to consider that.
Okay, so, for that volume growth focus, Mr. Jacob, give us a sense of what has changed. So Q4 has seen a sort of a positive change for the oral care segment. I mentioned right in the beginning that rural has been a driver. Give us a little more detail on this. What has changed on both these aspects? And do you see this as a definitive shift?
Yeah, I mean, the category volumes have been picking up over the last few quarters, more driven by urban. But in recent months, we are also seeing urban is kind of joining the party. And, we called out in the analyst presentation that we are growing faster in rural than urban. So there is some optimism in rural with, inflation kind of moderating. There is the future seems to be good with monsoon news seems to be indicating normal levels of monsoon. So there are positives there. Overall, the category is growing, as things stabilize elsewhere. And as you also know, we have a big thrust on consumption building in the category. We are running the brush twice a day campaign. And we've been spending a big proportion of our media budgets on that. And it's running across platforms. And you've probably seen during IPL also on JioCinema in the second match, we do show some of the prominent commentators being part of that campaign. So there is a lot going on in that area. Of course, that will gradually help build volumes, but there are multiple factors coming together for this.
I pledge to vote and encourage all my colleagues at Brokerage Industries Limited and associate companies to exercise their voting rights. It's the essence of democracy, and we stand firmly behind it. I would also urge everyone else to vote. We are thrilled to join NDTV's pledge to vote campaign and help spread the word in the corporate world and beyond.
Thanks for tuning into Talking Point. I'm your host, Niraj Shah. Our guest today adds a bit of difference to the conversation that we do because he tracks the emerging market space very, very closely. From his earlier avatar of being an India dedicated fund manager to now looking at the emerging market space at large at Breakout Capital Advisors, managing partner Swanand Kelkar with us on the show. Swanand, great having you. Thanks for taking the time out.
Thanks, Niraj. Always a pleasure.
The pleasure is ours, Swanand, because it becomes imperative to talk about the expertise that you bring to the table now. Not that you didn't bring it earlier, but now even more so, simply because the last 2 weeks, Indian markets were not at the mercy of, but certainly got impacted by a lot of chatter around how some of the India dedicated funds either got liquidated or wound down and the selling that happened, and the long-standing conversation about how EMs at large are not getting so much of capital because of the China factor. Just give us how does somebody who invests across EMs look at that space currently, and then we'll get to whether India can break out from the EM basket, if you will.
No, thanks. So I think I cannot bring any expertise to a 2-week trend either.
Of course.
So let me get out of that first.
Yeah.
But I'll talk a bit about emerging markets and what's really happening, because in India sometimes you're so preoccupied with what's happening within our vibrant markets that you don't look at what's happening elsewhere, and rightly so at times. But what's been happening in EM, and it's a very diverse asset class, multiple countries, there are 2 or 3 things. One is that over the past, maybe over a decade, EM has got their balance sheet act cleaned up. And that's across households, corporates, and in most cases, even the public debt. So I'm not talking of China here, I'm talking about most other EMs apart from China, which is a very good thing for starting a new cycle, that your balance sheets are much more clean and much more lighter than what they were, let's say, 10 years ago. The other advantage I feel for EMs is that the inflation experience in EM has been much more benign than what it has been in the developed world, and that's a divergence from what it was maybe 2 decades ago. So even if you look at the quantum of rate hikes, right, that have happened in the developed world versus what has happened in the EM, if you look at where the inflation numbers are, most EMs today are running positive real rates, which means that the inflation is much lower than the policy rates in those countries. Again, a good starting point that eventually when things fall in place, Fed starts its rate cutting cycles, a lot of EMs will follow, and that will set the base for an EM cycle again. And the third thing, of course, is valuations. I mean, it has been one of the most ignored asset classes, as you would know, for the past decade or so. I mean, we had the 2003 to 2008 EM rally, and since then, not much has happened, really speaking, within that asset class. Some justifiably so, some not so justifiably, because all eyes were on the US. People have made, which has been the US's decade, the last entire 10-12 years. So that's the starting point for an EM. If you, as a stock picker, if I tell you that, okay, the balance sheet is light and clean, there seems to be some sort of a growth angle which can now come up, and valuations are cheap, it's the time that you start looking at such a stock. And that's exactly what is happening. So we have seen some money trickling into EMs over the past maybe 6-12 months, not in a big way, but there is at least some attention coming back to the asset class. India, of course, within that whole thing had stood out remarkably for the growth characteristics that the country has and the differentiating characteristic of the domestic flows, which are not present in most other EMs, at least in the quantum that we have had them in India over the past 5 to 10 years.
Yeah, a bit of a differentiating factor for sure, even to India's relative history as well, Swanand. But just one more follow-up there. Do you believe, I mean, because I heard you say that the factors that you enlisted will help an EM rally. You invoke 2003 to 2008. I'm not saying that is what will happen. But do you foresee a probability that in this decade we'll have an EM rally wherein all EMs could move up at the same time? And would a global rally be necessary for something like that?
Oh, interesting question. So if you go back to that 2003 to 8 golden period for emerging markets, right, there was a EM growth model. And that EM growth model predominantly was about exports. It was about exporting to the developed world. And there was commodity exporting emerging markets, which sort of fed into what China was doing, their huge fixed asset creation which was happening in that country. So those were the 2 EM models which could synchronously take the entire asset class up. India then, if you remember, the index weight for India and MSCI EM was mid-single digit. It's almost 18% now, right? So it's a very different EM as an asset class that you are looking at today. But you ask a very valid question. I think this time around, there isn't one overarching single EM growth model. There will be different countries which will have different interesting drivers, but there isn't a single model which will lift all the countries together. So there will be a domestic demand-driven model in places like maybe India, Indonesia. A country like Vietnam is still pursuing the East Asian tiger model of exporting to the developed world. There will be countries where there is sort of a value angle to them. I said that EM is trading cheap. There are at least 4 or 5 large emerging markets which are trading at single-digit PEs, where you get the basic inflation growth dynamic on an even keel, and you get some sort of an EM re-rating or the country re-rating. So I think it's a very diverse EM model now versus what it was in the last cycle, which is why you need to have a bit of active stock picking. I'm selling my book here, but which is why you need to have a bit of active asset allocation at a country level as well as stocks level this time around.
Okay, and a follow-up to that is, I heard you say, for example, that Vietnam is following the export-driven model, not everybody else is. So would therefore select markets like India and others be chosen by an EM fund manager for the domestic demand that it brings to the table, or also because of this whole conversations run over the last 24 months about what China plus one, Europe plus one, etc. brings to select countries like maybe India and others, that they will export what China used to export, they will export what Europe used to consume and make in Europe, but now being made on their shores.
Interesting. So again, when an asset allocator allocates money to a country, it's rarely a single bullet point sort of a rationale, right? So you don't allocate money even to Vietnam only for their export model. Vietnam has a very buzzing tourism sector, as you know. So there are always multiple growth drivers in a single economy. Having said that, India is one of the few places which has a large domestic consumption base, which also still has a fairly large catch-up to do in terms of the capital stock within the country. There will be places where exports, China plus one, Europe plus one, manufactured exports, services exports even, which is done much better than manufactured exports, I would argue, would be part of that rationale, would be part of the portfolio. But I think that single factor model, which drove growth of some of the East Asian tigers, I think India will have many more growth drivers than just a single, like a single economic factor.
But it is not